Hi guys, welcome to this Money Control live stream. It's a Friday morning and here I am in the studios of Money Control, Nandita Khemka. Over the next 30 minutes, we'll be talking about a whole host of stocks that will be making headlines today. Cues for trade, of course. All your stock-related queries will also be answered by our technical expert who will be joining us shortly on the show. As far as the setup goes, yesterday we notched another record close, although we came off from the record highs, but ended above that 24,300 mark for the first time. Even the Sensex managed to hold on to that crucial 80,000 mark. This morning, GIFT Nifty is looking slightly iffy, but who knows? We can, even if we look at a weak open, we may pick up pace and perhaps end the day on a record note as well. But of course, we will be taking stock of all of that after we take a look at the top headlines at this hour. Asian markets trade firm with the Japanese Nikkei hitting record highs despite a dip in household spending. Wall Street was shut on account of Independence Day holiday. The GIFT Nifty is indicating a negative start for the Indian market. Crude prices remain range-bound around $87 a barrel as data indicates a possible cooling off of the US economy. However, gold edges higher on hopes of a Fed rate cut in September. Watch out for the jobs report that comes out later today. And among stocks in news, HDFC Bank's deposits and advances dip in the first quarter while CASA ratio also declines. Also watch out for RBL Bank, IDBI Bank, UCO Bank, macro tech developers, Kalyan Jewellers. All of these have reported their business updates for the fourth quarter. Bajaj Auto gears up to disrupt the two-wheeler market as it rolls out the world's first CNG bike later today. The bike, named Freedom 125, will have both fuel and CNG tanks. And Team India were felicitated for the T20 World Cup victory last evening amid much fanfare. In fact, the Indian team led by Rohit Sharma and Virat Kohli had a gala time at the packed Marine Drive and Wankhede Stadium, where fans gathered in huge numbers to get a glimpse of their heroes. Well, what a grand welcome there for the heroes of the T20 World Cup, sea of humanity. That was it kind of speaks volumes about the kind of love we have for this sport and the sportsmen as well. But almost just about 10 minutes to go for the markets to open. Let's take a look at some of the cues that are coming in this morning. Yesterday, as I mentioned at the start of the show, we ended flat, but it was a record close nonetheless above that 24,300 mark. IT and banks saw selective buying ahead of earnings. Sensex gained somewhere around 60 points or thereabouts to end above that 80,000 mark. Nifty Bank managed to recover from the day's losses towards the end of the session and managed to end above that 53,100 mark as well. Just to tell you about the F&O cues then, the PCR put call ratio rose to 1.27 from 1.24% in the previous session. In F&O ban, we have some new entrants today, Aditya Birla Fashion, Bandhan Bank as well as Piramal Enterprises. Two of the counters will still remain in the ban today, Hindustan Copper as well as India Cements. In terms of fund flows, domestic institutional investors were net sellers yesterday to the tune of 2,300 crore rupees in the cash markets, but FII net buy figure was once again in excess of 2,000 crore rupees as we had seen in the day before session. Yesterday as well, 2,500 crore worth of buying coming in the cash market as well. But on that note, let me bring on board our technical expert for today. Joining me is Raja Venkatraman of NeoTrader. Raja, great to have you on the show. We have been breaking barriers, on the higher side. 24,500 is the next major level to watch out for. Do you expect that to happen today itself, or would you say perhaps in the next couple of sessions? And in terms of Nifty Bank Index as well, 53,000, on the lower side, it seems to be a good support. But since we have held on to that 53,000 mark, do you expect a dash towards 53,500 anytime soon?
Yeah. Good morning, Nandita. Thank you for inviting me to the show. And while the indices are breaking barriers, the market participants are not able to break their barriers. And that's why you will see that the barriers in the mind are what is displayed on the screen right now. And the constant hesitation which is reflected on the price action clearly spells that only select few are participating and people are waiting for the provincial dip which did occur on the election day, but nobody encashed it. And now after market has risen so much, everyone is waiting for the dip. So my suggestion would be that keep participating, because the dip, if you are expecting a big one, is not going to occur. Now, coming to the levels, yes, the option data clearly suggests that the lower levels are held at the moment. So, easily breaking down 24,000 would be a challenge. And on the Bank Nifty, I would say 53,000 is a very important support. So, if we were to trigger a downside, the first step would be on Bank Nifty. I would see on an end of day basis. On the upside, 24,600 seems to be an important level to track on the Nifty. Crossing that would be a challenge for the next few days. So it's a buy on dip, sell on rally situation right now in the markets. But what we need to consider is that in indices, the challenges will remain, because it's going to move a bit slowly. But what's really happening is, with the Q1 results coming up, there is going to be a lot of action emerging on the stocks. And we are seeing that the IT, which was lying low for almost the entire first half of the year, is showing some promise of delivering decent numbers. Now, that's a promise we got to see what when it comes out. But then the way the price action is demonstrating, there is a good set of movements even from the leaders as well. So IT sector is the sector to play for. The other sector which I would like to highlight is the chemical sector, which has been overlooked for a while. So IT and chemical have been overlooked for a while, and they will continue to play. So, and the third sector would be pharma. So I am concentrating in this particular series on IT, pharma, and the chemical sector, because these three sectors seems to be poised for some growth. Any pullbacks in the stocks that are performing well, you can take a lot of names out there, and all of them have been doing well. So these are some sectors which I would track for. So overall, market is on the bullish side, but then I'm expecting some bit of decline here. So the declines could be towards the region of around 24,100 to 150, and that should be a good dip to buy into. Well, buying on breakouts on the indices at the moment is not advisable. On the Bank Nifty, I'm expecting a support levels around 52,500. So that should be good enough for the next week. And when we meet again in the next week, we'll discuss the further levels.
Sure, 52,500 important support level to watch out for on the Nifty Bank Index. Of course, we will be discussing it next week as well. But before I move on to some specific banking names, I want to get in your thoughts on what's happening with the likes of Mazagon Dock. There's no stopping the shipbuilding companies. GRSE, for instance, in the last 1 month has doubled. Like, last 1 month, when I talk about that, it was 4th of June, right, when we saw that massive fall coming in on the index. Since then, all these shipbuilding companies have seen, renewed traction, and GRSE has doubled. And yesterday, Cochin Shipyard, in fact, saw a 20% kind, not Cochin Shipyard, I beg your pardon, Mazagon Dock, saw a 20% kind of an up move. What to do with these two stocks? Is it time to take some profit?
Yeah, see, before the election and also on the election day, when the results were a little tentative, the defense bubble, everyone thought that the defense bubble is going to be pricked, and we're going to see a cascade, because if the government doesn't come in force, and the defense promises which they were saying could not be enforced, then we'll have a problem. But then what really happened is the reverse. The defense sector was reinstated. They made a bigger claim for spending more on the defense side, and then the kind of 2 days ago, the ruling which came out that they're going to reduce the import and then give business to the defense companies. All this is triggering lot of positive tailwinds to this sector. So if you are holding this particular stock, then one could definitely look at booking some profits. But if you are not, then this would not be an appropriate moment to enter, because at this juncture, entering, say, a Mazagon Dock or a Cochin Shipyard or a GRSE would also require you to have capital to buy it at lower levels. Instead, you could take a look at some stocks like HAL, BDL, which are just starting its move, or Zentech. So defense right now is a very interesting sector. A lot of people are participating, and there are a lot of stocks that are coming into play, because everyone wants to get a share of the government outlay. So it's a very interesting space, but then you got to look at stocks that have just moved, say, post the election by just say 10%, 15%, and not look at some stocks which have moved by 30, 40%, because even if they correct, their tenor is not going to change. So one should be very careful and not get overexcited, because markets are going to give opportunities. But then if you get excited and get into the defense space right now, especially in the names which you mentioned, you will definitely burn your fingers.
Okay, that's the advice coming in from Raja on the defense names. Don't go around burning your fingers, but be very selective when you choose these stocks. But aside of that, one more stock that will be reacting to news flow today is Raymond. Board has approved its plan for the demerger of the realty business, right? And shareholders shareholders will be getting one Raymond Realty share for every one share held in Raymond. The stock has gained almost 40% in the last 1 month. Do you think the risk reward is looking attractive here after the kind of move it has seen in the last few sessions?
Yeah, so you see, in the last 6 months, in the last 3 months, the stock has nearly doubled. So with this kind of move in such a short span in time, I would definitely advise if you are a holder to book profits. But if you are somebody who is actually looking to enter into this stock right now, the suitable levels would be closer to the region of around 2400 to 2500 and not at the current juncture.
Okay, look at entering at 24,500 levels and not at the current levels. In fact, we also had a query on the same from Debu K. Hope that answers your query, Debu. But then just about, I think, a few seconds to go for the markets to open. Before that, I want to get in your thoughts on a PNB has come out with its first quarter update. Pretty strong. Loan growth has been strong. So has deposit growth. In fact, domestic loan to deposit ratio has also improved. Looks like PSU banks in terms of earnings are faring better than private names. So particularly PNB, how is it looking on the charts now?
See, PNB has been waxing and waning, and if you take a look at what has happened since the start of the year, it has been pretty much range bound. So positive news flows does emerge, but then I would be a wait and watch here, because any move below 110 would definitely bring in a steep correction. So I would not be approaching PNB at the moment. I will be taking a look at what's really happening before I take a call.
All right, wait and watch approach on PNB, but hold that thought, Raja. We have, got the market opening bell ringing here. So yes, the Nifty has opened in the red, 60-point cut at open. The mid-cap index, which was, looking a little okay, has also slipped in the red. Banking pack is also in the red. In fact, 300-point downtick coming in, 52,780 is where we are at when we're talking about the Nifty Bank Index. Sensex as well below that 80,000 mark. So it is an iffy start, but not a very bad start. The GIFT Nifty was already hinting at a quiet start for the market, and that's exactly what has happened. We've opened with a negative bias. But in terms of sector, I want to see which one is outperforming today. Nifty Bank, as I mentioned, is in the red. Aside of that, if we look at, the energy pack, FMCG pack, these are the ones that are standing out today. You have the pharma pack as well extending its gains from yesterday, 0.4% higher. The PSU banking pack is in fine fettle, although private peers are not in favor this morning. IT continues its uptrend. It's a 0.3% kind of a gain coming in there. Yesterday as well, IT and pharma, these two were the pockets that were outperforming. Today as well, defensives are taking the lead. The Nifty metal pack is also in the red, as it had given up most of the gains yesterday as well. Realty also in the red. So aside of the defensives, most of the pockets are in the red. Even the auto pack marginally in the green, but no big moves coming in there. In terms of the individual movers, let's take a look at what stocks are doing. HDFC Bank, after the first quarter update, it's down 3%. It's a top Nifty loser. Remember, the update is not all that encouraging, because both gross loans and deposit growth are soft. CASA ratio has declined. Although the liquidity coverage ratio here has improved sharply, but of course, clearly reacting to that first quarter update. Tata Steel, Titan, M&M, Maruti Suzuki, Adani Ports, these are some of the other laggards. What's gaining is Cipla, that's the top Nifty mover. Hindalco, ONGC, Divi's Lab, Bajaj Auto is also in the green. Remember, it will be rolling out the world's first CNG bike today. So this stock will be taking center stage. Wipro extends its gain. Divi's Lab is the other one that's moving. Raja, coming to you, looking at the texture of the market, what are the stocks that you're keeping on your radar in terms of recommendations for viewers?
Yeah, so the first stock which I would like to suggest is, like I mentioned, Pharma Pack is definitely doing well. So I would like to go with a long in Glenmark Pharma at the current levels. You can have a stop loss at 1290 and target towards 1325, 1335 as a day trade. And this is looking quite good because amongst all the pharma stocks, this stock has been sustaining the higher levels for the last few trading sessions, and every dip has been a buying opportunity. So that's why I am suggesting Glenmark. And the second stock which I would like to recommend is Siemens, because this stock has shown some very good trajectory, and the recent pullback into supports have been bought into the, and since the election dip, the stock has only been gaining strength. So I would like to suggest it at current levels, have a stop loss at 7825 for a target towards 7985 and 8050.
All right, those are the recommendations coming in from Raja. But Raja, hold that thought. We'll come back and take queries with you and talk about more stocks. But let me also bring on board Sandip Agarwal, who's the fund manager at Sowilo Investment Managers, joining in. Sandip, great to have you on the show. Before we talk about the markets, I want to get in your thoughts on HDFC Bank. The first quarter update, has been a little on the softer side, even though liquidity coverage ratio has improved. Of course, there was a lot of, optimism around the stock, especially since it has recovered quite smartly from February lows, right? Almost 30% uptick from there. But all the good news surrounding the, weight increase on the MSCI, do you think that's digested? And the next trigger for the stock could be the first quarter earnings. Do you expect the stock to give up some of the gains?
Yeah, good morning and thanks for having me on the show. As you rightly mentioned, the credit growth was very weak at -1% quarter on quarter. And also the CASA ratio has fallen sharply to 36.3%. So I think, it is not very encouraging as Street was anticipating. Yes, the stock has moved up a little bit on expectation of improvement in rate change in MSCI and all that. But I believe that, this business has to improve, particularly deposits growth has to pick up, and obviously CASA ratio has also to move up, and also the growth has to pick up. So all the three parameters have to move up. Earlier credit growth was doing well, but deposit growth was very muted. Now we have a new problem here. But I would say that the way markets are doing and the way economy is anticipated to do in next few years, remember that banking is a very good proxy to play the economy along with the manufacturing and the services cycle. So I would say that at this price, at this value, you may have some underperformance for a short tenure period, but then, there is a very good proxy to play Indian economy and also the manufacturing, because when the manufacturing industry does well, it has needs for banking, it requires working capital and many other aspects. So, indirectly, all this flows down to banks, and HDFC is one of the leading banks, so must be a natural beneficiary.
But would you still prefer PSU banks, or do you think the kind of run-up that we've seen in the PSU banks compared to the private peers, valuation-wise, private banks make a better play now?
So, PSUs have run up a lot, but there is a reason to it also, because there the deposit problem is not as acute as we have seen in the private side. So they are having little advantage of being in the remote places and the remote areas where the awareness for other asset class, primarily the equity class, is little less, and because of that, the deposits are still strong, while the private banks have lesser presence in those regions, so their deposit growth is a little weaker comparatively. So I think they have that advantage. Secondly, PSUs, I think, are in the last leg of the right back cycles, so this benefit should also fade away in next 3-4 quarters. Till that time, I think the reported numbers for PSU may still continue to be slightly better than private, but I would not be choosy to buy PSU. I will be more inclined to buy private banks which are fairly valued.
Okay, that's the view on the entire banking space. But what about the IT pack? A lot of optimism building around IT stocks, mostly because there were a lot of underweight positions, right, on IT. Earnings wise, first quarter is expected to be weak. Perhaps second quarter could see some traction, or third for that matter. But would you also be in the camp that believes that, now is the right time to get into the IT space and wait for that recovery to play out later in the fiscal year?
So, it is a very interesting question. So let me put it this way: 2 years back, almost like 8-9 quarters back, when IT stocks made a peak, and after that they started gradual fall. The key reason of fall was not demand; it was primarily to do with the very high attrition. The attrition numbers went up from 12 to 28% for the leader like TCS also, and because of that, margins fell sharply. The subcontracting cost went up sharply. Now, if you see last 3-4 quarters consistently, we are seeing attrition rates are falling very sharply, and the subcontracting costs are falling, and consequently the margins have started showing an uptrend, and also the order books are very good. So I think, from valuation perspective, the big names, there is a lot of value, like the Tech Mahindra's, HCL, Infosys, all of them. In the good quality mid cap names where growth has not taken such a sharp dip, the valuations are still stretched. So I think the buying start should be always with good quality large cap which are at reasonable price. And then when you get a good price to enter, then you can look at good quality mid caps also. But overall, I think, at least the large caps are very fairly valued, and this is not a sector where you can expect 15-20% kind of year-over-year growth every year. Post-COVID during COVID, it was an exception because there is sudden spurting demand because of work from home and all. And now there is sudden spurting demand because of AI in the consumer market, and that will flow down to Indian market also. So I think growth will pick up, but this is, remember, a 8-10% kind of growth sector, and with some slight margin improvement. So 12-13% kind of EPS growth sector where the stock return should also be like 15% annually. And if there is more return in 1 year, the next year it will cool off. So that is the way it is.
Okay, but particularly for COF Forge, of course, it has acquired some 11% stake in Signity Technologies for somewhere around 400 crore rupees or thereabouts. When the acquisition was announced, I think we had a few brokerages red flagging this particular acquisition, saying that this may not turn out to be EPS accretive. Any thoughts here on COF Forge? Do you think this acquisition bodes well, in terms of flow through to earnings? How are you viewing this?
So, I won't comment on a specific name, but let me put it this way. I have seen global technology and global telecom acquisitions in last 20 years, right from Alcatel, Lucent to Nortel, everything, and even in the technology side. So, if you come to Indian space, I have not seen great success except for 1 or 2 platform-related deals which have happened in the past. They have been very successful, particularly done by Alphabet. But if you come to the services side, if you see Accenture, they keep on doing acquisition every month, but the size of acquisition is very, very minuscule. It is like in decimal points. So you never know what is the outcome of those actually. But large acquisition in India, at least, whether it is Tech Mahindra's past acquisition, if you go and see, whether you see Cyient, everyone, whenever they have done acquisition, it has been very challenging to integrate, and margins become very dilutive, or the exit clauses are not tough enough to retain the existing management. Some or other, I don't see any success story in India in merger acquisition in Indian IT services except for Tech Mahindra Satyam. In that case, actually they got Satyam at a very, very cheap price. Let me put it that way. So if the price was not so lucrative, maybe they would have also diluted their returns. But other than that, there is no success story, honestly, at least fundamentally. So I think, while I will not comment whether Signity is good acquisition or bad acquisition, but I will definitely say that in this business, you have to be extremely choosy about the acquisition and the size of the acquisition. And secondly, you must be extremely choosy to select skills over revenue. So that is the way I would say.
Okay, point taken. The other one, sector that's been in focus is the cement basket. Quite a few mergers and acquisitions happening in that space. Of course, Ultratek's buyout of, in fact, stake buy of India Cements being the recent one. But how are you viewing this whole, cement pack now? There were price hikes recently as well, but brokerages had said that those price hikes may not be really sustainable, given the fact that demand could see a dip in the wake of monsoons. So here on, given the kind of consolidation that's happening, would you say that it's time to stick to large cap cement names, or would you say that look at the smaller ones because they are getting acquired by the larger ones, so the runway for growth is higher there? How would you look at it?
So, cement and auto, two sectors are such where every month you get data. So they are actually not even seasonal. They are monthly seasonal. Let me put it that way. So the challenge is there is too much data. But the way I look at it, see, a few years back there was immense competition in the airlines, and today we see there are 2-3 players. So and they are making good money, and they are doing sensible business now. Let me put it that way. Same thing we saw in telecom. There was cutthroat competition, multiple players, multiple circles, and no one was making money. Now there is some sanity, there is efficient execution, and there is rationality. I think in cement also, because there are so many small players, there has always been, irrational behavior from the players. So I think with consolidation happening in this space, maybe 2, 3, 4 large players, it will become a 4, 5 player market going forward, and that will bring rationality to the sector. Remember that cement is a very good proxy to economic growth, and particularly for a country like us, which is developing, where infrastructure is the key focus. I think we will have phenomenal returns in the cement. But right now, we are probably in the last leg of consolidation. Once this consolidation gets over, the smaller ones go with the large names and the strong players. There will be much more execution efficiency, the freight efficiencies, and all those things. There is a lot of money to be made in long term. In short term, month on month data, the monsoon data, the seasonal data, and all those things will keep things choppy. So you have to accumulate when you get good opportunity, good value, and you have to sit tight for a long term.
Okay, that's the view then. But before I let you go, Sandip, just want to get in your thoughts on where are we headed from here. We're almost looking at 25,000 now on the Nifty. But right now, do you think there is case for consolidation, given the fact that we have the first quarter numbers coming out, starting to trickle in from next week? Do you think this rally will take a pause now?
So see, I think right now there are events lined up. There is a budget where there is expectations from different sectors, the announcements and all that. But having said so, see, I am not in the camp which believes that the market is insanely expensive or expensive. I believe that market ranges and the forward earnings multiples should always be seen in perspective with multiple things, right from macro factors, the currencies, the central bank policies, the growth expectations, and the focus of the government, and all those things. And if you take all those things into account, I believe that we are not in the range where we can call it expensive. I think we are doing, our economy is doing well. There is a lot of spend which is happening on the infrastructure, and the stocks are mostly proxies to that thesis. And I believe that, for a long-term investor, making 12-15% return in a year is not going to be difficult. We are very optimistic. We are optimistic based on fundamentals and not the levels. The levels, you can have some correction, maybe 1-3% in a short while, but then it will be short-lived because finally fundamentals do pick up. So I don't think we are insanely expensive at all.
Okay, that's the view then. Not expensive, and expect double-digit returns going forward. With that, Sandip, as always, thanks a lot for taking out time and sharing your insights with us. Look forward to our next chat.
Thank you.
Well then, let's go back to Raja on that note. Raja, let's quickly delve into all the queries that we are getting in this morning. One query has come in on IRFC from the railway space. This one has come in from, I think, Sandeep Poddar. Wants to know your thoughts. IRCON is the other one that's been in focus because of an order win. I think it's up 3% or so. But, railway, after seeing an eye-popping rally, the gains have now become a little more tempered. Do you think, because we have seen the gains slowing down a bit, it's time to get into some of these names like IRFC and perhaps IRCON?
Yeah, see, these kind of names definitely have a lot of interest ahead of the budget. So once again, these names are popping up, and railways, defense, the PSEs, all these sectors will definitely attract attention, and we should continue to participate in such names. But then the caveat here is that we got to see whether the move which we are envisaging is unfolding or not. So first of all, if you're talking about IRCON, the movement has been a bit sluggish, and if you're expecting that a strong rise should emerge, just like the defense. I think that it will take some time. So if you are when you're going to get into any sector, you should also think about the kind of moves which is being displayed and what is our temperament. So if you're having a temperament to hold for the next 1 year, the prices can double from here. Otherwise, IRCON is not the stock. IRCON or IRFC is not the stock which we should get into right now.
Okay, avoid at the current juncture. That's the view. But moving on to the next one then. Aditya Reddy wants to know your thoughts on an Angel One. He is holding 15 shares at the rate of 2,785 rupees per share. And he wants to know if it's okay to hold it for the long term. Just a few days ago, we saw a knee-jerk reaction on some of these broking names because of the SEBI circular on charging uniform fees, right? But Angel One has reported its first quarter update as well. So I think the stock is reacting to that. But is it a good hold candidate for the long term?
See, this stock has seen a very magnificent rally upward trajectory in 2023, but then 2024 is exactly the reverse. So you can say that 1/3 of the gains made in 2023 has already been eroded. And while everyone continues to believe that this stock would recover from lower levels, I reserve my opinion because it is going to take a while right now. And if one were to really exit this holding, then the levels will be at around 2250.
Okay, that's the view then. Any thoughts on L&T, how it's going to do from here? Manish has a query on this particular stock. Is it worth looking for a trade, or should one take positions and perhaps wait for 6 months?
L&T, the last 6 months has done nothing. So expecting it to do a miracle in the next 6 months, it's not looking like one. But then yes, L&T is a household name and everyone wants to invest into L&T. But then one should look at better names than this particular stock at the moment.
Okay, what about fertilizer? After a very good run, we saw some bit of profit taking kick in on names like GNFC. Mrinal Banerjee wants to know your thoughts on a GNFC. How should one navigate some of these fertilizer names now?
Yeah, so like I said, the specialty chemical is a sector which I am tracking because these set of stocks which you are mentioning have been forming a base over the last almost 6 months. So they have almost many stocks have formed a double bottom as well. So I'm waiting for a breakout, and one should be definitely tracking them. GNFC, a breakout above 760 should definitely be participated in. At the current juncture, it's more of a trading bet, but then above 760, it will become an investing bet with a target towards 1030 for the next 6 months.
Okay, that's the view on a GNFC. But I want to get in your thoughts on a Poonawalla FinCorp. Came out with its quarterly update yesterday. Just want to see how the stock is really doing. Extremely flat, but we have a query coming in on this particular stock from Shrivardhan Gupta. Should one get, this stock is one stock that saw a very good run as well, right? So should one play it for higher levels?
Not at all, because over the last 6 months, this stock has actually come down. So whenever I am looking at any kind of an opportunity, I am seeing whether pre-election, was it holding higher levels, was it trying to do better, and then it saw a brief correction, or it has been coming down since the start of the year. So if it has been coming down since the start of the year, not much interest is stepping up right now. And even with the markets moving higher, the stock is actually coming down. So it's an avoid from my side.
Okay, avoid from Raja's side rather. So there's another query that's coming in on ITC, not doing anything in today's session. In fact, last 5 sessions also it has not done much. Last 1 month as well, extremely flat. Should one look at it from the FMCG pack, or would you suggest names like a Marico Dabur right now?
Yeah, see, again, ITC, L&T, the legends are not performing. Well, it's time for us to move on and look at some other names. There are a lot of names that are performing right now. So better look at new names. Just like in the cricket, the older ones are retiring. So maybe it's time for us to change our opinion.
Yeah, but I don't think a lot of people are happy with them retiring just yet. But of course, can't really be helped. But I think with that, we've come to the end of the query segment. Of course, Raja, as usual, always taking out time and joining us on Fridays. That's a great thing, and helping our viewers navigate their queries as well. Look forward to seeing you next Friday as well. Have a great weekend.
Thank you. Bye.
Bye. Well, with that, of course, we've come to the end of this show. Let's see what the markets are doing. We are, in fact, almost at the low point of the day. I think it's a 100-point cut on the Nifty. The Sensex is also cooling off by 450 points or thereabouts. And the Nifty Bank Index, in fact, has even slipped below that 52,500 mark. So that support that Raja was mentioning has been taken out for now. But we'll have to see whether or not we manage to see some bit of recovery kick in the second half of the session, or we end the day on a negative note. Although for the week, I think we are still poised to end higher. Mid cap index managing to hold out, but slim gains coming in there as well. But with that, completely timed out on this edition of Opening Bell. Thanks a lot for joining us at 9 a.m. like every other day. Of course, you guys have a great weekend. But before that, don't forget to join us at 3:30 p.m. on Closing Bell as well. Have a great day.